So again, the aim of this workshop is to give you a toolbox. It's presented today on behalf of myself, Gimli Ventures, and Brattleboro Development Credit Corporation. Again, this is the first of 3 presentations. Now, the first thing that we're going to cover in this presentation is kind of the overarching theme when it comes to accounting in general and how accounting impacts you as a business owner or as someone that is integral to the financial aspects of a business. Maybe you're a spouse and your business owner, the business owner is, I like to call it with like my husband's business. My husband is the talent and I'm the money person that handles things on the background. And maybe that's a role you carry similarly. So again, if this is something that is beneficial to you, I want you to have the resources that you need. Now, when it comes to accounting, there wasn't like this hodgepodge style that just got thrown together as far as how accounting is monitored or created. There isn't, just like this thrown about method of things. It's a very structured process. All accountants are looking to stay as close to this guideline as is humanly possible. The guideline that they're using is something called the Generally Accepted Accounting Principles. And again, it's a standardized system that creates rules on how all of financial documents are created. Now, if you're a little mom and pop store, you're not doing anything, that is like, let's say that you're just a little at-home business. You don't earn enough money to file your taxes. You, are not doing anything with financial documents as far as sending them out or taking any kind of loans or anything like that. It's rare, but that might be an instance where you sit, and that would mean that you probably don't have to be overly concerned with these, but I will tell you it is in your best interest, even if you're a tiny little mom and pop something and you're not using any of these things now. It's important that you get these structures in place, because the hope is that you'll grow larger than where you are. And I don't want to see you get to a point where you're sitting there and you've kind of got this hodgepodge system in place and you have to overhaul everything to get yourselves on a more standardized process. Now, the entity that created and monitors the GAAP program is the Financial Accounting Standards Board. It's made up by a number of financial professionals, including accounting auditors. And so this is it's a process that people have to be able to create standardized documents and create visibility and understanding that gives any company out there a way to present their information. It also creates clarity in one's business to have the documents created to, grow their business and understand where their finances sit. So accounting documents, there's a number of accounting documents, and I figured we would go through some of these. So the first one that we're going to cover is called the income statement. And its primary purpose is to show if a business is profitable or not. You're going to see things in your income statement, including, but not limited to, revenue, expenses, cost of goods sold, and net income. And I'm going to give a little gap here. You're going to find that I'm going to leave a little bit of gap in between each session. So if there's, some sounding questions, we can try to get those covered and assist people. So I got this obviously from Investopedia. Investopedia is a great resource. I would say if you have a pen and paper handy, if you're not familiar with this, it's a really, really good website to be able to utilize and get understanding around, different parts of your business, different terms you may run into. And they do a good job of explaining things. Sometimes they can be a little bit, they can use language that can be a little bit tricky to understand, but they usually have good points of reference to further explain categories. So if you're not really sure what, you're seeing in your documents, you can kind of look through their further explanations of different subjects to kind of get some more information. An income statement, again, is going to include revenue, gains, expenses, and losses. And it breaks down your net income. Now, you'll see that this particular document comes up a couple of times. There are other terms that people utilize for income statements, and they're laid out in different fashions depending on the type of business to be able to kind of show just a rough idea of where the business is standing. Now, the balance sheet is another accounting document. Its purpose gives you a better overall understanding of not only where a business sits currently, but any assets or debt that a business has taken on since it was started. It also shows you the understanding of who has stake in the company. So if there are multiple investors, if there's multiple business owners, if there's liabilities that a business has, this is a good place to look to kind of get an understanding of what's going on in this business, more than just understanding, is it profitable or not? Now, this is an example of a balance sheet. Now, balance sheets can look overwhelming to people that are unfamiliar with them. You'll see that they're broken up into several categories, but they're ideally broken up, and all accounting documents are broken up into two sides of an equation, and they should balance out always. There's never an instance where you wouldn't want these to balance out. If there is a balance difference between the two of these, it's because there's an error somewhere in the accounting documents. Now, you have assets on one side. Assets are anything that the business owns. And you have liabilities or equity that are on the other side of the equation. These are, now, owner's equity seems like it would be an asset. It seems like it would be something that the business has value in, and sometimes this can be confusing for business or for business owners to understand. But this is something that if the business were to have to liquidate for some reason, or if a owner wanted to buy out of a company, this would be something that the business would be liable to pay that owner that was trying to leave. So that's why it's important that owner's equity would be on this side. And again, you have assets over here, including cash, accounts receivable, prepaid inventory, prepaid rent. Now, prepaid rent and prepaid inventory, prepaid insurance, these are all categories that can seem a little bit confusing to smaller businesses, because people think about you have to spend money to make money, and they think if they buy all of this these items at the beginning, like during the year, and they think that they can write it off. You have to be aware that with general accounting programs, you have two types of accounting programs. You either have cash-based accounting and you have accrual-based accounting. Now, accrual-based accounting, that's when you'll see things like prepaid rent, because you can't in a year utilize all of that income that was coming in, or utilize all of that expense. If you're doing things in accrual method, you can't buy all of your rent for a year, even if the year ends in January. Let's say that you buy 6 months of the following year in an item. You have to be careful that that business has to back out the assets of things that they have bought in advance. So it's one of those categories where people can oftentimes get hung up, and they think that it's smart to buy things ahead of time and buy things like buy a whole year of things that they may not use within that accounting year. So again, your balance sheet is always going to show assets versus liabilities. So the statement of cash flows is another accounting document, and it goes over cash coming in and out of a business. It's kind of giving you an understanding of not only what business or what income is coming into the business, but what types of activities are leading to income within the business. So if you have a business that has several functions, maybe you're a t-shirt manufacturer, but you also make hoodies and jackets, and you make polo shirts. Having an understanding of which arms of your business are making different forms of income can be really valuable to a business. So that's why the statement of cash flows can be really valuable to understand what business sectors make sense to keep and which ones may not make sense to keep. If you're a business owner that has multiple arms of your business, and even like if you have parts of your business that are fundamentally very different from others, it may be important to separate that type of income so you can truly get an understanding of where the healthy parts of your business are and where are unhealthy parts of your business. So this is an example of a cash flow statement, and this one here, you'll notice it covers a month ending. Oftentimes with a cash flow statement, you may see that they're yearly numbers, but typically cash flow statements are shorter windows of time. They're usually like monthly periods or quarterly periods. Cash flow statements, you don't always have to see them in a yearly fashion. So sometimes they can be beneficial to pull that information and get a better understanding of where you're going month to month. So in this particular instance, in Greg's popsicle stand, he started out the business in July of 2019. Day 1, 2019, his business had $5,500. And in that time period, he brought in another $3,500. He saw assets that he owned depreciated by $500. And he had an increase in accounts payable. So money that was owed to the business that hasn't yet been paid is considered an asset. They don't factor into this whether or not the businesses that owe money to Greg's popsicle stand will actually pay out. They just give you an understanding of what is due into the business. Now, you'll see that this one here is an increase in accounts receivable. So this one here, so this one here is a money that's due out of the business, and this one is due in. So understanding, where the cash flow is as far as money that's coming into or out of your business is really crucial. That's what we're looking at here, is just understanding, how things are changing based on money that's, being paid out or due in. Now, in here, you're also seeing that there is liability in the fact that they purchased equipment, and that now becomes $5,000 that the business owes to someone else. And from the 5,500 point, they've seen that the cash flow from the entirety of the month is $500. You'll want to understand that this entire month, there was a lot of things that happened, but the net of everything was only $500. So from the beginning of July to the end of July, they only netted $500 and increased their cash position by $6,000. So this is kind of one of those things where there's a lot of moving parts and pieces, but understanding at the end of the day where you ended up can be crucial to understand, is my business doing well or is it not doing well? So we've talked a little bit about revenue, and revenue is an area where I try to break this down a little bit because people will look at revenue in a lot of different fashions. And you may hear this referred to as net revenue. It's the same thing. Just different places will call it different things. Coral, your comment on the receivable and positive on payable, you're right. I misspoke there, so I apologize for that. When we're looking at revenue, you're talking about all of the income that came into a business minus any discounts. So if your business is offering, a 20% off, you're not going to factor your revenue on what would have come in. You're factoring it off of what actually came in. Now, this isn't if you sold a t-shirt for $15 and your cost to create that was $12, it's not, the small amount of money, the $3 that you received at that point. When they say net, I don't want you to be confused with the fact that it's not a number after any sort of costs. It's just the money that you received in minus any discounts. So don't let the net number throw you. Now, cost of goods sold is when you're looking, and cost of goods sold is a category that is really, really, really crucial to understand. Now, let's talk about that t-shirt again. You have a $15 t-shirt and your cost to create it is $12. The cost of goods sold is where we're going to factor in the total cost of everything that goes into making that product. So the materials, let's say if we're making a t-shirt, it's the blank t-shirts that you guys or the company that would have to buy, maybe the stickers that go on the shirt or the vinyl that goes on the shirt, and then the person you have to pay to create that shirt. let's say that's all $12 per shirt is what it breaks down to. The cost of goods sold helps a business owner understand exactly what they're making on each item. So that's where cost of goods sold will vary very, very differently from your net revenue number. And again, don't let net revenue throw you as some sort of number that is minus any sort of expenses. The only thing that comes out of revenue is discounts that you apply on the front end.
Jennifer, would you just mind for a second? I think there's a bit of confusion in the statement of cash flow. So if you don't mind going back just a second over there, and I will go over to.
Sorry about that. So
no worries. I can take it if you want from here. The cash flow statement just measures the cash in and out. Okay. So when we say increase in accounts payable is something that you have to pay for your suppliers, but you didn't actually pay it. So it's an increase in your. Let me open my camera. So it's an increase in your cash because you still have that money, didn't pay it out yet. On the other hand, accounts receivable is the money that you should receive from your clients, but you haven't actually. So that would be the negative. So you're netting out the cash in and out. So again, accounts payable is something that you have to pay, but you haven't paid it yet. So that will mean that you have increased your cash. Accounts receivable is the opposite of that.
Yeah,
I hope that cleared it.
I think that the reason that people get confused by this is because they stay here because they're basically theoretical numbers. If you, for some reason, didn't pay your suppliers, you still have this cash and you haven't paid them. And if your people haven't paid you, you haven't received this $4,000. Again, it's factoring on the fact that these numbers may not end up being what they're being. Like say, one of your suppliers says, oh, we made a mistake. You don't really owe us $5,500. You may not actually pay $5,500. And you may find that $4,000 is what everybody owes you, but you may not actually receive that. All right, and getting back, oops, went way too many expenses here. So cost of goods sold, I want you to kind of understand this, that labor costs, direct labor is what there's a difference between direct and indirect, factors when it comes to expenses. And we're going to go over this in a little bit more depth. I think there's a little bit of confusion as to, what is an indirect or a direct expense. So just kind of keep in mind that when we're kind of talking about cost of goods sold, it's direct materials and direct labor. And we're going to go over that in a little bit more depth. So operating income is a category that people often see. It's in a number of accounting documents. It's in a number of, different resources. If you're ever trying to take out a loan or get investments in your company, this is a big number that you need to know. And it's one that's an important category to be able to explain. So your total revenue, and this is all the income that came into your business minus discounts, minus cost of goods sold. It's also known as income from operations. Again, it's total revenue minus cost of goods sold, and it takes out all operating expenses. Now, your operating expenses will include sales, general expenses, administrative expenses, and that category is also known as SG&A, depreciation and amortization, and other operating costs. So this is kind of a good representation of where your business sits as far as what you're creating and how that's pulling in. So the understanding with this is that when you're looking at your operating income, this number here does include people that you have to have working in your business and helping to create different parts of your items that you're creating or services that you're providing. Expenses. This is a really the idea behind this is fairly simple. I mean, anything that the cash that is going out of your business or the liabilities that you're incurring to try to create different products. So again, they come in variable and fixed. So fixed would be something more like your rent, whereas variable might be something like your utilities. And again, direct and indirect expenses. So direct expenses would be something that directly goes into making a product or service, whereas indirect expenses would be something more like the software you use to track your accounting, the things that are not directly going into, say, that t-shirt that you're creating. So if there's printer paper, that has nothing to do with it's not going in the box that the t-shirt is shipping out in. It's not directly going into any portion of, what you're creating. Those are indirect expenses.
Jennifer, if you just would mind just a second. Dina has a question, but I don't know if I understand it correctly. So Dina, if you feel like unmuting yourself and correcting me if I misunderstood your question. The question is, and you say more about labor cost as part of cost of goods sold versus when they're not. So if I'm understanding correctly, direct labor costs can be part of cost of goods sold if the labor is directly involved in creating the object or the product that you are producing. Let's say you are trying to create the shirt. If someone is sewing that shirt by hand, the salary of that person is considered a direct labor cost and will be included in the cost of goods sold. However, if you have a salesperson that is selling that t-shirt, that person is not, the salary of that person is not included as part of the cost of goods sold, but rather will be accounted for as an expense in the salaries, in the selling and general administration expenses. I hope that's clear for you.
I think she made a comment that the question was answered, so I feel like we've got that one, which is good. But thank you for jumping in there, because I want to make sure we're getting everybody's questions. So again, expenses, when we're talking about, understanding the difference between direct and indirect expenses and fixed and variable, you want to make sure that you understand which items are going to be moving and which ones are going to stay the same, because that's going to be crucial to understanding the highs and lows of your business. You may find that certain utilities, and I put it, you'll see that a lot of the resources will say that fixed expenses include utilities. And I think that these are more situations where you have them on like a budget billing or things along those lines. I did include it in here because you'll see in some of the in some of the resources that they list it there. But I can see the argument that utilities could be one or the other, especially if you have a business that has a significant change in your utilities. If you're, a business that has, significant office space, you may find that your utilities are through the roof in the summertime because you have to pay to, air condition a space. Whereas in the wintertime, you may not have as much utility, or I would say like in the spring and fall, you may not have that same utility cost that you do in the winter or the summer. So just kind of take a note there that the utilities that they're talking about are ones that you have on a fixed status. And so that's just one thing I like to call out with people, is that utilities can fit under both categories. Now, variable expenses, commissions, credit card fees, materials. I also like to, call out here that sometimes people forget that there are variable expenses in the respect that they may have them as a fixed amount, but they don't present all the time. And that's where we can see some aggressive changes in expenses if there's something that maybe only presents itself, quarterly or biannually, or, whatever the case may be as far as how you pay that. That's something that can be considered a variable expense when it presents itself is really, really variable. Now, direct expenses go directly into creating a product or service. So it's important to understand that there are going to be times when you feel like something directly goes into what you're creating and it may not. And this is something I see a lot with businesses that are struggling with high expenses, is to understand what is actually going into making that product, and looking at the indirect expenses, because those might be an area where if your business is having cash flow problems, or there's a lot of high expenses, not enough income to support it, looking at those indirect expenses can be really, really valuable to try to get your business out of being this cash eating machine into better supporting itself and ultimately staying afloat. So depreciation and amortization. Amortization you might have heard of if you've looked at buying a home. It's that obnoxiously long, like 47-page document that goes over when you make a payment, how things break down and how they are paid off. Now, depreciation you might have heard when you're talking about vehicles, because you see that vehicles will depreciate, cars will depreciate, technology will depreciate. This is all a process that is a very distinct fashion, and it's created in a very structured way. People will buy things for their business thinking, I need to spend money to make money. And it's important to understand that the IRS has a very specific process on how you can depreciate assets in order to, realize that business loss. So it's important to kind of understand that there is a structure behind that, and not just to buy things to, eat up all expenses within 1 year. Amortization is spreading out the cost of funds used by a company to buy, take care of, or upgrade physical assets. So when we're talking about items that a business owns, when you're talking about how it will, how that payment of something breaks down, and how that's going to ultimately, impact your finances in the business. Ingrid, I'm going to pause here because Ingrid had asked if she would like to know more about indirect expenses. So indirect expenses, some good examples of indirect expenses would be things that happen on the background of, creating items or selling items in your business. So if you have software that doesn't directly go into making a product, say accounting software, somebody that you have to pay to run the accounting and books in your business. If you have people that sit in the background that sell products or services, if you have, items that are necessary for your business to function, but they don't directly go into something. So computer equipment that's in the, in the business, those are good examples of indirect expenses. And I hope that answers your question. If you have some more concerns over specific expenses that you're trying to understand if they're direct or indirect, feel free to pop those in the chat box and we can kind of go over those. So interest and tax expenses. These are something that all businesses are going to need to function with. They're all things that you're going to need to experience at some point or another when it comes to your business when you're talking tax expenses. Because no matter what state you're in, your business is either going to be subject to federal, state, or municipal taxes. Now, there are instances where you may not owe, like if your business is in a position of losing money, you may not have tax expenses in the respect that your business is losing money. That's the one exception to tax expenses and having that money that you owe. When it comes to interest expenses, you'll always have this if your business is taking on any sort of debt. Now, interest expenses are if you use a credit card for your business, the finance charges that you're paying monthly, the interest you have on any types of loans, things along those lines. And to clarify, debt is anything that a business owes or a business owner owes on behalf of the business to anyone for any reason. Now, these are important things to factor in because there are certain, again, loans and investment programs where they want to understand exactly how much of your expenses are tied up in interest and taxes. And there are instances where businesses of, say, larger natures will try to skew the tax and expense numbers to make it look like their business is not as profitable as it is. And that's one of those instances where you'll see that there are programs that ask you to peel out or look at your expenses without tax and interest. ROA. So return on assets is a measure that is important to understand because there are a number of places that will utilize this. So business sectors within a larger business will be looking at this in the form of management. They'll be looking at how different business units, how different parts of the business are using their resources to turn a profit. Or if there's instances where they find that maybe different products or services that they're offering are not operating well, not providing the right profit in relation to how much resources they're using. Investors and analysts will use this when they're looking at a company to understand if they're a good company to perhaps invest in, or if it's a public company and there are instances where there's stock and things along those lines that are out there. For the average business owner or business unit, it's just an important number to understand. Should you keep all of the things that you're putting out there, or does it make sense to get rid of something and replace it with something that might do a better job of turning a profit with using less resources? To calculate this, we take net income and divide that by total assets, and it's displayed as a percentage. So this again is a resource that can be valuable to business owners, and it's good to kind of have a better representation of not just say unit cost, but understanding how much resources it's taking to make a particular product and whether or not it makes sense to keep that. So taking a second here, I wanted to go over budgeting. Budgeting, I will tell you, is probably the most valuable thing that any business owner can do in their business to keep it beyond the dreaded 5-year point. And I say the dreaded 5-year point because 80% of businesses that are created close within 5 years due to cash flow problems. And so it's important to understand what's going on in your business and how that money coming into your business is managed. Understanding the highs and lows of your business, understanding if your business is going to have enough money to support expenses that are higher in the summer or whatever the case may be. People will say that budgeting in your business is restrictive, or it's keeping you from growing. It's not giving you the right resources to allow your business to be what you want it to be. And I will argue that budgeting is one of the most crucial things that you can do, not only, from the perspective of keeping your business afloat, but also making sure that your business is getting the right resources so that A, the owners are getting paid, B, the taxes are getting paid, and so that the business has the right support to be able to continue growing itself. So in order to succeed with any budget, it's really a fact-finding mission. You're never going to get from point A to point B with your finances if you don't understand where you currently are. And the average business owner struggles with a number of things. They don't understand, what they have for expenses. They don't understand what they're taking out of the business, and they don't understand what they need to be setting aside for taxes, and there's no system in place. When we're talking about your expenses, not only understanding what your expenses are, but understanding, the percent based on your total income, the understanding how your business cash flows in any given month. I'm going to pause on the idea of what people are drawing out of their business. All too often, I'll talk to a business owner, a relatively new business owner, I should say, and I'll say, hey, what is your business paying you? And that's what we mean by drawing out of your business, whether it's through salary or owner's draws. It's important to understand exactly what the business is doing to support the lifestyle of the owner. And every so often when I'm talking to business owners, I'll say, what is your business paying you last year? and they'll say to me, paying me, I don't really know. All of my expenses just happen in my main checking account and it's not separated. I don't really know what my business is paying me. If this is you, or if you know a business in this circumstance, if you get nothing else from this training, I would encourage you, if you currently have your personal and your business finances intermingled, please separate them. Go and create a checking account with another, or get another checking account with your current bank, or get another bank and get a new checking account. It's really, really crucial that you keep your business and personal finances separate. I am not a lawyer, but I will tell you the advice I've gotten from a number of lawyers I've interacted with. If you're creating a separate business entity, whether it's a sole proprietorship or an LLC, when you create a separate entity to create a separation between your business and your personal finances, so if you're ever in an instance where you're sued, if you're going through that legwork to create an LLC, and your business and personal finances are intermingled, if you should ever be sued, the argument can be made that your business and personal finances are one, and that separation that you created by making that LLC essentially goes away. So if you currently have your business and personal finances in the same account or significantly intermingled, please do what you can to separate those out. All too often, I talk to business owners that I say, what % are you setting aside for taxes? Or do you have a formalized process for setting aside money for taxes? And this is an area where a lot of business owners sweat. A lot of business owners are concerned. I would say the good majority of businesses, when you're having that meeting with their accountant, they're not sure if they have enough money set aside. And it's an important factor in any business to understand exactly what to be setting aside for taxes and make sure that you're not tapping into those. And if your business is not set up properly to be able to make sure that the money that needs to be set aside for taxes stays, set aside or is paid out to the government, quarterly, if you're constantly tapping into that money for normal cash flow operations or to pay yourself, this is where a lot of businesses go really, really wrong. And unfortunately, the IRS, as much as they are, a fully operating machine and they're, this necessary part of things, they're also one of the most dangerous things when it comes to a business owner, as far as they can take your assets, they can take your income, they can take anything that they can get access to. They can take it, and they can take it without any sort of legal action against you. So it's important to understand that the IRS is not the place to play the fast and loose in your business finances. So budgets don't need to be this crazy complicated thing. They don't need to be intricate. They don't need to be you don't have to have a fancy software to do this. You don't have to do anything crazy articulate when it comes to budgeting. But they do need two pieces. Two pieces have to be in place. You have to have future planning, and everything has to be tracked. When I say everything needs to be tracked, this is an example of a very, very simple budget that I put together for a coaching client earlier this year. And, they're a very small business. They don't have a ton of moving parts. But this was just an example of, one simple budget that we put together for them. It was just understanding the income that was coming in and how that affected the balance and expenses that were going out. Now, for this business, we had a list of all expenses, and we would understand that down here, we had a list of what expenses were going to come out later in January, what expenses were expected in February. So we could see how this 92,1546 was going to drop down to $6,000, and when income needed to come in order to support those expenses. Not only does it give you an understanding of how your cash flow will change in a given month, but understanding your highs and lows can be the difference between, I can make a business decision today and I can take on another expense, or maybe I need to pull back the reins because if I spend this money here, I'm going to put myself in a pickle come February. So it's important to understand, not only where you sit today, but understand how that cash flow is going to change, and be intentional about tracking the dollars that are being spent so that you can see, you know, where you're going to be in a week or 3 weeks or 5 weeks. When I always tell businesses to look at understanding how cash flow happens in your business, there are some people that will, you know, inevitably do things in their business that hurt themselves. So it's important to kind of understand where are the keys as far as maintaining good cash flow in your business. So I always say the keystone to everything is tracking all of your spending, because the biggest place that you're going to hit a pitfall when it comes to your business finances is overspending and not having any idea how that spending is impacting your, you know, day-to-day business transactions. The next thing that's one of the most crucial pieces, and I tell this to every coaching client that I've ever interacted with: hire a CPA. A CPA will always get your money back. A CPA is one of the smartest investments that you can make for your business, even if all you're doing with them is having them look over your taxes, having them look over how you're tracking all of your income, you know, and your income and expenses in, say, QuickBooks or something along those lines, having them look over your books if they're done on paper, having them understand and, you know, be able to give you sound advice when it comes to, you know, how you interact with the IRS. They're also going to be, in a lot of cases, the difference between your business doing well and your business not doing well, because one of the largest expenses you're going to have in your business is oftentimes going to be your taxes. And there are a number of times where I've had coaching clients that have, you know, not taking advantage of a CPA, not taking advantage of, you know, a bookkeeper or anything along those lines, and had, you know, overpaid in taxes because they were just doing something really wrong when it came to their books. So a CPA is one of the most fundamental things that you can do. The next thing that you want to look at is these 3 functions here. So when it comes to your business, a business that isn't paying the owner, or a business that the owner just keeps pouring money into, is not a healthy business. And oftentimes I see this when there's no line of sight to what's going on in the cash flow, or there's no restrictions on what the business is doing as far as expanding products or rolling out new features, adding in, you know, additional equipment. This is an area where your business can quickly destroy you if you've got way too much going on or not enough coming out in the respect of the owner pouring in or receiving back. And these 2 functions sort of go together. Let's say that you're a t-shirt company and you make, you know, 10 different types of t-shirts. You may find that you'll get requests for, do you guys make hoodies? Do you guys make jackets? And it can be quick to presume that the thing that you should do is instantly add these products that people are asking for. And I will tell you, as a newer business, when me and my husband first started, he had merchandise that he sold, and we had gotten a lot of requests from people to buy or provide different products. And then in the end, we found that they didn't sell as well, despite the fact that we had, you know, a handful of people that were asking for them. So it's important to understand, when it comes to your business, it's important to try to take it easy and go nice and slow and offer the minimal viable product offering. So what can you provide and still be profitable? What can you provide and not grow your overhead considerably? What can you provide and not have to buy new equipment, or, you know, things along those lines? It's important to understand that you may not need to do that today. Maybe it's a move that you make in 6 months or a year, but if you try to grow too fast, it can often destroy your business. The next thing is freelancers versus employee. Oftentimes I find that this is a point of pride for businesses, is that they want to see that they're doing well enough to hire somebody. It's like a milestone for most business owners to feel like they have taken on a person. Or it's an issue where there are things in the business that a person doesn't want to do. You know, when it comes to a lot of businesses, some businesses, they don't want to do their books. They don't want to do their, you know, different expenses. They don't want to do, Maybe they don't want to do sales calls and they want to hire a employee. It's important to know to take it easy when it comes to this. And if there's an opportunity to utilize a freelancer or somebody that you don't own on your payroll, somebody that you don't have to pay benefits for, or maybe you hire them for 4 hours a week as opposed to 40. It's important as a business to try to tread lightly when it comes to making the jump from a freelance employee or a part-time person to a full-time employee. The next two functions are being prepared for taxes, because again, not having enough money set aside or constantly dipping into your tax savings can be detrimental to a business. And obviously prospecting for your business. If you rest on where your business is today, oftentimes in 2 months or 3 months, you won't have what you need to be able to sustain the future, because your business is always going to see clients pop on or drop off, and that's normal. So the next thing I always tell businesses is it's important to understand that having too much debt in your business can completely destroy your business. And I put this picture up here. It's pretty funny, but it's a understanding of the fact that reality happens. And I don't think that, in 2019, anybody had the realization that 2020 was going to do what it did. Nobody realized that there was no expectation that the world was going to shut down completely. And unfortunately, there are a number of, businesses that, just didn't survive 2020. Having too much debt can mean that, you're in an instance where, you have a business downturn and you can't afford to pay those lenders. So it's important to understand when you're taking out debt, or if you're in an instance where, you're thinking about it, to realistically have that conversation and understand, if we have a significant downturn in business, can we still afford this? So just try to keep that in mind, that debt is one of the biggest issues I find with businesses as far as cash flow and having too much going out in expenses. It's easy to say I need to make an expansion, or I need to grow a business model, or I need to take on equipment. It can be hard to have those conversations, when your business is drowning in debt. And I always tell people it's really common that you see businesses will spend emotionally. I need to do this. I have to do this. I want to do this. And then justify intellectually. So just try to keep in mind that you should take a minute and try to have that conversation. Do I need to do this? A perfectly good example I had this week was a business owner that a little bit of imposter syndrome was telling her to go back and go to grad school to get another degree, when in reality that degree doesn't have a lot of translation to whether or not she would be, making more income, and whether or not she would be providing more to her, clients. So it's important to understand, do I have to do this? Do I need to do this? Is it smart to do this? Now, this is a good list I give to business owners when I say, hey, tell me what your expenses are. These are a lot of the typical areas. So you've got supplies, rent, office equipment, advertising, websites, professional equipment, legal services, licensing, whether it's with the state or the federal government, permits, insurances, modifications to workspaces, and staffing. So these are generally the caveat areas. I also tell people, if you're looking to understand what your expenses are, pull a bank statement or a credit card statement, depending on what you're using, for the last month. And then if your business has been in business that long, pull up last year's. So I would pull, say, your November and December bank statements or credit card statements to understand what could maybe pop up again once a year. That's a good way to kind of look at those things and understand, what are my expenses, if you don't already have a good list handy. So I wanted to pause here and give you guys opportunity to ask any kinds of questions. See if there was anything that you guys wanted to walk through, or anything that you guys had concerns with.
And for anyone that has a question, if you're familiar with the raise hand feature, you should see reactions in the toolbar at the bottom of the screen. Please use that and I'll unmute you.
I also tell people too, sometimes there's things that you've heard of, or, you know, somebody else in a business has, you've seen in the industry. It doesn't necessarily have to be something that you yourself have encountered, but if you've seen something and you know somebody has done something that you're like, hey, I always wondered about that, this is a good opportunity to ask those questions as well.
Jennifer, Steve Proctor had a question. I rely a lot on my profit and loss as a dashboard. Are there things I will be missing there?
I suppose it depends on, you know, what you're putting into the software that is driving the profit and loss. I had a business owner that I was working with earlier in the week that, you know, he didn't break down where his income sources were. He was a gym owner and everything went into sales. It was just sales income. That was everything. And part of that was, remote coaching that he was doing with clients that were not members of his gym. Some of that was retail sales of product that's in his, you know, in his lobby area, or like equipment, water bottles, things along those lines. And then some of it was membership. So sometimes your profit and loss can hide certain features, or certain nuances in your business. It also is not always the best way to look at your expenses and understand if you're doing well financially, because you may be looking at a large window. Let's say that you're looking at a year, or you're looking at 3 months or 6 months. You may not see that there's highs and lows and seasonality in your business. I would say almost every single business out there has some degree of seasonality. So not understanding, you know, where your business is financially, and not understanding, you know, that certain months are going to be harder than others, you may be missing an opportunity to, you know, look at whether or not certain expenses make sense. Maybe you have an expense that only happens in July, and it's an indirect expense. It's not something that goes into whether or not a business is, you know, a function. It's not part of a product or service you're offering. It would be a missed opportunity to just rely on your profit and loss if you're not seeing what goes into that. So the profit and loss is kind of like a nice overview, but it doesn't get into the granular functions.